Welcome to today's Explainer. I'm absolutely pumped to jump into this with you, because today we are looking at a literal earthquake in the tech investing landscape. We're talking about a fundamental, massive shift in how the smart money views the future of artificial intelligence, and specifically the tech giants building it. If you've been following the AI arms race, you already know the big players, but a recent massive portfolio move has completely rewritten the playbook. We've compiled the data, we've built the breakdown, and we're going to look exactly at who is moving their money, where it's going, and most importantly, why.
Okay, let's dive into this. $8 billion. And no, that is not a typo. That's the staggering amount of capital that was just aggressively repositioned away from one of the most beloved, seemingly invincible tech giants on the planet. I mean, when $8 billion moves in the market, it's not just a trade, right? It's a profound statement about the future of technology. It's a huge bet that the current narrative we're all being fed might actually just be wrong.
Part 1. An $8 billion AI bet.
So, who's the architect behind this whole thing? It's billionaire hedge fund manager Chris Hohn, who runs TCI Fund Management. Now, Chris Hohn isn't exactly known for making impulsive decisions. He's a strategic, heavy-hitting super investor. So when word got out that he was dumping a massive stake in Microsoft, the market took immediate notice. In fact, Microsoft shares took a 1.1% hit right on the news of this filing alone. The question everyone on Wall Street is suddenly asking is, what does Chris Hohn see that the rest of us don't? Just to grasp the magnitude here, at the end of 2025, Microsoft made up a massive 10% of TCI's entire portfolio. It was literally a cornerstone position. But by the end of March 2026, Hohn had slashed that down to just 1%. He didn't just trim it, actually scratch that, he effectively gutted it. This is a wild departure because for years, TCI has been one of Microsoft's most vocal, confident believers.
To really understand the psychology of this exit, you kind of have to look backwards for a second. TCI had previously ridden a massive 400% rise in Microsoft stock. They held this position for 9 years, reaping just unbelievable rewards as Microsoft transitioned into the cloud era under Satya Nadella. To ride a winner for nearly a decade, generating a 400% return, and then abruptly pull the plug? Wow, that tells us this isn't just about taking a little profit off the top. This is about a fundamental, deep-seated change in conviction.
Part 2. TCI's massive portfolio shift. Now, what's really interesting about this slide is if you're taking $8 billion out of one of the premier AI companies in the world, where on earth does it go? Looking at the precise breakdown from Dataroma's Q1 2026 data, the strategy becomes super clear. Look at the Microsoft row, an 83.74% reduction in shares. But check out what's happening right around it. Hohn is simultaneously pouring capital into Alphabet. TCI added 16.55% to their existing Google position and initiated a massive new buy in Google. This pivot has made Google their absolute largest tech position, now sitting at 5% of their total portfolio. So he isn't betting against AI, he's just entirely changing his horse in the AI race.
Moving on to Part 3, the AI threat to Microsoft.
So what's the underlying rationale behind Hohn's aggressively bearish pivot? To get this, we need to look at the specific warnings Hohn gave his investors. On one side, we have the Microsoft we all know, historic, unbeatable dominance in productivity software with Office, and an absolute growth engine in their cloud computing division, Azure. But contrast that with Hohn's specific AI fears. He's warning that rapid AI advancements could entirely disrupt those established Office workflows. Imagine new AI-native platforms that just bypass Word, Excel, or PowerPoint entirely. Plus, he sees mounting competitive challenges in the cloud space for Azure. Basically, he's looking at Microsoft's greatest legacy strengths and viewing them as their biggest vulnerabilities going forward.
And, well, it gets even more complicated when you look at Microsoft's highly publicized partnership with OpenAI, the folks behind ChatGPT. You'd think this makes them the undisputed leader, right? But investors like Hohn are growing increasingly uneasy. Microsoft is spending billions upon billions on AI infrastructure. The burning question is simply, what are the actual returns on that massive spending? Hohn's decision to exit really amplifies this fear that all that spending might not actually translate into defensible, proportional profits.
Which brings us to Part 4. Wall Street disagrees.
Because here's the thing. While Chris Hohn is heading for the exits, the broader market and institutional analysts are decidedly not following his lead. Here's the mainstream bullish perspective perfectly encapsulated. Ivan Fenseth, an analyst at Tigris Financial Partners, directly defended the software giant just days after this news broke, simply stating the fundamentals remain strong. Wall Street isn't buying the doom and gloom narrative. They're looking at the present-day realities of Microsoft's business, and they're seeing an absolute fortress.
And this brilliantly illustrates why Wall Street remains so confident. Check out these concrete Q3 fiscal results: a 29% jump in cloud revenue, a staggering 123% increase in AI-related revenue. Analysts are using these exact, hard data points to justify their position. Microsoft isn't just talking about AI, they're actively monetizing it at a blistering pace right now.
We definitely have to balance these two realities. Yes, according to TipRanks, hedge funds broadly trimmed about 2 million shares of Microsoft over the last quarter, likely just taking some profits off the table. But look at the analyst consensus here. 33 out of 35 analysts still maintain buy ratings. They've got an average price target of $559.98, which implies a massive 34.5% upside potential from current levels. The highest target even sits at $680. The professionals who model this company day in and day out, they still see enormous growth ahead.
So the crucial point is understanding who actually owns the risk here. Looking at the TipRanks ownership breakdown, the massive chunk is public and individual investors holding over 50%. You got ETFs and mutual funds taking up over 43% combined, but look at that tiny, practically invisible sliver at the end. Insiders hold just 0.03%. That is a microscopic amount of insider ownership, which suggests management has very limited direct skin in the game compared to the public. It's definitely an interesting metric to consider when a massive institutional player like TCI suddenly bails.
Let's wrap this up with Part 5, the future of AI dominance.
As we bring this explainer toward its conclusion, we really have to zoom out and look at the macro conflict. We have an $8 billion bet against Microsoft's dominance by a historically brilliant investor, contrasted with rock-solid quarterly earnings and overwhelming Wall Street optimism. Right now, the broader market is absorbing Hoag's massive move with, let's call it, measured concern. A 1.1% drop is pretty modest given the size of the stake sale. But the ultimate impact of AI on big tech, that is completely up for debate. Is this massive shift in computing paradigms going to be the ultimate growth engine for legacy giants, or is it an existential threat to the workflows they've monetized for decades?
And that leaves us with the billion-dollar, or rather, the $8 billion question. Will AI erode Microsoft's competitive moat? Is Chris Hohn a visionary, seeing the cracks in the foundation before anyone else, or has he just walked away from the greatest AI compounding machine of our generation? Thank you so much for joining me for this explainer. I really want you to think about the data we went through today, look at your own portfolios, and consider how this $8 billion bet is going to age over the next 5 years. Until next time, keep learning and stay focused.